We not be worried about A, what's happening in the stock market, but B, and maybe more tellingly, what the bond market is saying?
I think he's mostly right. I grew up as an equity guy on Wall Street, but I developed a healthy respect for the bond market and the signals that it sends. The fact of the matter is you rarely meet an optimistic bond trader, so the bond market always is a glass half empty type thing. I think the bond market is certainly sending us some signals that there's an economic slow patch here, whether or not it's a supply disruption because of COVID-19 or something longer term remains to be seen. We think it's a short-term patch of weakness, and we'll move out of this.
Are we getting, I'll get your reaction, Ron, to the same question. Is Larry right? Are we wrong to overestimate what the bond market is saying? But as Scott just mentioned, we are in the middle now of apparently more blossoming cases of this COVID-19. And you look at some of the economic impacts of that, and it seems to me that the first quarter and maybe the second, the numbers are going to take a hit.
Well, I think that's really important, Tyler. I think this is now going to be a first half of the year event that's disrupting the supply chains coming from China and from most of Asia now, South Korea, Taiwan. You know, Japan contracted even without the impact of the coronavirus by more than 6% in its fourth quarter. That was because of a national sales tax that was put in place. Now, I want to split Larry's comments in two parts. Number one, no, you should never panic, period, and end of story, if you're a long-term investor with a disciplined program. Two, I do think he might be underestimating what the bond market is telling us simply because it's not just the bond market. Utilities as a defensive play have gone to new all-time highs. They're up 8% for the year as a group. Gold is surging. Bond rates are down. The yield curve has inverted again, 10 years to 3 months. And so I think you're getting slightly more powerful signals from defensive sectors of the market that would suggest that this might linger for a period longer than we'd anticipated. And two, the global economy itself might not be in the midst of that rebound that we thought was taking place just a few short weeks ago.
Scott, talk to me a little bit about what Ron just identified there. It's not just the bond market. It is other defensive sectors that have been doing very well. That's number one. Number two, we were talking over at our pod earlier. There are a lot of businesses that are cutting prices and giving away stuff, basically. Look at the financial services business. Look at what's happening in streaming. The prices are coming down, coming down. This may suggest businesses in the last gasps for air of an economic cycle. Fair point?
It could be, but I think there's a secular trend here as well. And I think people will earn PhDs in economics for this generations from now, trying to understand why over the past 10 years, with monetary policy worldwide as easy as it has been, there is no greater inflationary pressure.
And no greater growth.
And no greater growth, sort of stagflation minus the inflation part. There's stagnation. I guess there's already a word for that. But I think a lot of this has to be in the yet fully understood dynamic of technology and the way in which technology brings down not only the prices of goods and services, but the price of delivering those goods and services. It's very difficult to measure, particularly when it's technological. But it's there and it's real, and I think there's a lot of the downtrend in inflation that's due to that.
Ron, what would you argue? Yeah, go ahead.
Well, I would argue that same point plus two other factors. So you have technological disinflation around the world that's taking place at an increasingly rapid pace. You have demographic deflation because of the aging of developed economies. And on top of that, you have episodic financial deflation taking place as well. When we get these modest or serious crises over time, they tend to disrupt what had been traditionally, the inflation picture where inflation goes up when unemployment goes down. I think it's a multifaceted issue that has broken the so-called Phillips curve orthodoxy that low unemployment produces high or higher inflation. I think that's a broken relationship, and for not just the reason that was stated, but for other reasons, this is a secular phenomenon. And it does leave policymakers in a bit of the lurch because, as Layla Brainerd said earlier in the week, at the next recession, they're going to have to jump on this and get very aggressive.
The only thing about that narrative that troubles me somewhat is there's another way to look at it, which is this is just a drawn-out cycle. The unemployment rate doesn't fully capture the fact that we are still bringing people into the labor market. So it's not that the curve is broken. It's just that we haven't gotten to the point at which it's generated higher wage gains. And if you look at what happened after the crisis here and elsewhere, there were a ton of regulations piled on the economies. And as they've started to come off now in the last couple of years under Trump here, other presidents elsewhere, that's generating a little bit of a lift in growth. But no one, no major, you don't have the IMF out there calling for deregulation.
No, but the one thing I'd argue about, Kelly, and I saw your guest previously from the Council of Economic Advisors, the notion that this economy is radically different from the one before. Job growth in the first 3 years of the Trump administration is actually slower on a monthly basis than in the Obama years. GDP growth is roughly the same. The composition has changed slightly, but because of the demographic issues, you are not getting a massive return of people into the labor force. So the participation rate has remained somewhat stagnant. And so there are demographic factors at work. Immigration, as apparently Mick Mulvaney may have hinted to some people privately, is extremely important. We have to grow the size of the population to increase GDP growth, because you can't get it without labor force growth and productivity growth. So I think there are a lot of things going on. I think in the shorter term, however, this coronavirus, weakness in Japan, and disruptions in production are going to be a 6 to 9 month event that's going to force everybody to lower their GDP estimates domestically and abroad, and possibly their earnings estimates for major companies as well. Hence, this hiccup we're seeing in the financial markets today.
That's an interesting point, Ron. Let me conclude with you, Scott, if I might. What would it mean? The United States economic optimism right now is at an all-time high. Never been higher.
Yeah.
Never, ever been higher. What would it mean to the United States economy and to the global economy if China's economy has a zero growth rate in the first quarter and the first half? Zero.
Not much is the qualitative answer.
Really?
Quantitatively, we figure it's something like 0.2 to 0.3% of GDP. If we're wrong, here's how we're wrong. I think people in this country are so positive because they look at their own paychecks, they look at their own job security. They certainly read the headlines, but they're still going out to dinner. They're still going out to the movies, going out to the mall. If, God forbid, when COVID hits here in greater strength and people stop doing that, that's when the impact on the U.S. economy is much bigger. We're a very domestic economy, very inwardly focused. Yeah.